In the class examples from Saturday, October 12th, example 3, we're given information on a cash basis and we're asked to convert it into the accrual basis and prepare an income statement and a balance sheet. Let's start with that income statement. First, we're going to need revenues. So our revenues are going to be based on the cash receipts. Now, cash receipts from common stock are not revenues. Collections from customers, they are revenues. So that's our starting point. And then borrowings from bank are not revenues. So what do we need to increase revenues by? We need our increase in accounts receivable, because if accounts receivable went up, that must mean we recorded a credit sale. And in item 1, we're seeing customers owed the company $22,000 at the end of the year. So we're going to add the $22,000. Now, if there had been a decrease in unearned revenue, we would also need to record that or increase revenues by that amount, but this is all we have here. So revenues on an accrual basis, $342,000. Next, we're going to have cost of goods sold. We're going to start with our cash payments, purchases of inventory, $220,000. And to that, we're going to have to look at the changes in inventory and the changes in, the inventory that we have on hand at the end of the period and the changes in our accounts payable. We have at the end of the year, $30,000 was still due to suppliers of inventory that was purchased on credit. So let's add in that $30,000 purchase of inventory. And then what you're probably thinking now is, well, we added the purchases of inventory, we added in the cash payments for the inventory, what we still owe for the inventory. You're thinking that's not cost of goods sold. But if we subtract from this our ending balance in inventory, $50,000 still remains on hand, then what happens to the rest of the inventory that we bought and didn't sell? The rest of it must have been sold. So this gives us cost of goods sold of $200,000 and a gross profit of $142,000. Next, we need to account for our operating expenses. And I'm going to go through the cash disbursements to figure out what our operating expenses were. We had payment of salaries, so I know that there were salaries expense. We paid our employees $80,000. And we have, in item 4, salaries owed to employees at year end were $5,000. So we have to increase it by that, because the only reason we're going to owe our salaries to our employees is because they worked for us. And if they worked for us, that was salaries expense. Purchases of office equipment, that's going to give me information for depreciation expense. Now, obviously, it's not going to be the full $30,000, so that's what the purchase was of the equipment. We need to know how long are we going to use that equipment and what's the salvage value on that equipment. So I take my cost, subtract out salvage value, and then I allocate it over the estimated useful life, the certain number of years. And I need to be told this information. So I see in item 6, the office equipment has a 10-year life. Allocate the cost across 10 years and no salvage value. So 30,000 divided by 10 years, or 3,000. Next, I have payment of rent on the building. Now, this is normally pretty simple. Take our cash paid for rent, but we need to make an adjustment here. The rent on the building was $14,000. We have to go to the additional information to find out how we're going to make this adjustment. And in item 5, it says on December 1st, $3,000 in rent was paid to the owner of the building that's used by the company. This represents rent for the months of December through February. So if we were putting this if this payment was made on December 31st, this whole amount would be prepaid rent. And so we could subtract $14,000 minus the $3,000, and the $11,000 would be the full rent expense for the year. So we know of a portion of this 14,000, some of it is the full 11 that went straight to rent expense. But then 3,000 was recorded to prepaid rent on December 1st, but then by the end of December, 1/3 of this, December's only, was used up. And so the full amount that actually was recorded as rent expense, what was used was 12,000 of that 14,000 total cash paid for rent. And so where's the remaining 2,000 of this 14,000? There's a prepaid asset, or prepaid rent is sitting as an asset on the balance sheet for rent for the months of January and February of the next year. All right, miscellaneous expense. This is easy. No additional information. It's just the 10,000. So our total operating expenses are 110,000. And our next step is to calculate our operating income. So if we take our gross profit of 142, subtract out the operating expenses of 110, our operating income is 32,000. One more expense, which is that given here, we borrowed $40,000 from the bank on April 1st of this year, and we have interest at 12%. The interest is going to be paid in the next fiscal year, so it's accrued. This is the journal entry, the adjusting entry at the end of the period to be debit to interest expense, credit to interest payable in the amount of 40,000 times 12% times the portion of the year. Remember, this 12% is for annual, for the full year. The bank loan has been outstanding from April 1st to December 31st, so 9/12 of the year. So this will work out to be 3,600. There's no information about taxes, so we just get down to our net income. 32,000 minus the 3,600 is net income 28,400. And we're also asked to prepare the balance sheet. We know we start with cash. And let's see what our cash balance is. We received 410,000 in cash, and we paid out 354,000. So our difference in cash is 410 minus 354, or 56,000. We have receivables. We know we used them when we calculated our revenue. Said in item 1, customers still owe the company 22,000. We have inventory. We were given that information in item 3. Inventory costing 50,000 is still on hand. And we know that we had prepaid rent, 2 months worth. We made this $3,000 payment on December 1st. We debited prepaid rent. We credited cash at the end of the month. We reduced prepaid rent by 1/3 or 1,000 and record rent expense, but we still have the remaining 2 months of prepaid rent, our rent for January and February of next year. We report our total current assets. $130,000 from long-term assets. We have equipment with a cost of 30,000. We recorded depreciation expense just this one time this period, because this is the company's first year of operations. So our depreciation expense is the same as our accumulated depreciation, 3,000. And our total assets are 157,000. Start with our current liabilities. We have accounts payable. And we were told that at the end of the year, 30,000 was due to suppliers for inventory purchases. We were told that we owe salaries to employees, 5,000. We know we have that interest payable of $3,600. Other side of that entry is here on the income statement. And we know we have that notes payable for $40,000. We don't have any long-term liabilities, so our total liabilities are our total current liabilities. This works out to be $78,600. For equity, we have our common stock. And we're told right in the beginning how much the company has in common stock. They issued common stock for $50,000. And for retained earnings, we're not giving any information about retained earnings, but this is the company's first year of operations. So beginning retained earnings was 0. We add our net income, $28,400. We would subtract any dividends, but there's no information about dividends, no cash payments for dividends. So our ending retained earnings is the income of $28,400. Total equity, $78,400. And total liabilities plus equity. Add the $78,600 plus the $78,400 and get $157,000, same as our assets.